Will Dalal Street feel any aftershocks tomorrow? We've got all corners covered for you. Here are some global and domestic market experts with their expectations from the Fed and its impact.
I think they should have hiked a long time ago, and I think actually they're coming late to the party, as we've seen in the credit disintermediation. The cost of capital has been rising since 2014, so early 2015 would have been the right time to do it. And as per usual, they'll be late to the party.
The market's very nervous about why is the Fed tightening, and they've got to give some confidence that they're doing the right thing.
The market will welcome some sort of commentary out of the Fed, which the market's desperately seeking some indication as to what after today. I think that the markets are fairly well priced in the fact that they're going to raise and that there's going to be a move. But I think we're going to be looking out further to what exactly are they looking at.
Jim Cramer back in 2007, the Fed, he almost forced them to start cutting. So in other words, credit in 2007 changed the Fed policy path. It changed it. And the same dynamics are happening today. It's setting up for potential. The Fed wants to do a number of hikes next year, but credit could overrule.
It doesn't make any sense to hike, but then you know, basically signal this is it. I mean, one and done makes no sense. They don't want to do one and done. The idea is that the time has come to start normalizing, and I think they want to normalize gradually. Of course, they can't make any real promises on that because they don't know how the economy is going to evolve. But the expectation is that this is the first in a series of hikes.
I mean, look, let's be clear. Tomorrow's happening, right? So the question is, does it impact the pace of hikes? And I think the way that you need to think about that is if what's happening in energy sort of bleeds out, and you're starting to see some of that. We actually think that by the end of next year, you're sitting at about 150 basis points on the policy.
We expect another rate hike in March, but we could see some the Fed actually turning more dovish and actually looking at rate cuts heading into the end of 2016. We're expecting the Fed to turn more dovish by the end of next year. We believe that the US growth could have peaked so far heading into 2016.
Well, I think the biggest difference now is this is going back to interest rate normalization. Normally when rates are being hiked, it's to slow down growth. This is the first time the Fed is actually making that step towards normalization. We should be celebrating this. You know, the Fed is in an enviable position. They're hiking rates because the US economy is in a good place.
They have to go this time. I mean, the last time, it would have been better to go the last time. Actually, conditions were better last time than they are now. So they're much better than they are now. The economy's not any stronger. The commodities have gone further down. Right. You got all these issues that are falling on top of us. You got the $1 issue, and the dollar's going to strengthen against the won again. Yeah. Oil is worse. So all of these things are not as good as they were in September.
I think that it's pretty clear that we're going to get a hike today. I think the markets have digested that, have priced that in. It's going to be important to watch three things in the aftermath of the decision. I think first and foremost is the U.S. dollar. So it's not just been about what the Fed has done in isolation. It's what they've done in context of global central banks who remain very easy with their policy choices. So I think if we start to see the dollar rally stabilize or even reverse, it could really profoundly change the financial market backdrop going into next year.
Normalization of U.S. monetary policy resulting in risk appetite globally reducing will continue through 2016, and that obviously has, that obviously means emerging market equities and Indian equities will face pressure from FII outflows. Emerging markets as an asset class will face redemptions, and hence FII equity flows supporting the Indian market, I think, will become a story of the past.
Will markets in India fall for a sustained period of time because of this? Will the economy be hurt specifically on account of this? What will happen to the rupee on account of this? You have 30 seconds to answer all of this, so you have to be specific.
Let's talk Thursday morning, assume the Fed hikes. I think the market will rally. The Fed rate hike is going to be a non-event. It's going to be a complete non-event for a couple of reasons. I think one, markets have broadly factored this in. They've known what's coming. They have the range of outcomes, and I think they've been, they've done what they needed to do. I think the Fed is run by highly competent people. And I think there are folks sitting outside who are worried about them doing something silly, when actually if you look at generally their record, I think they've generally been a very responsible central bank, and so I don't think they're going to do something which is going to, bring the world into crisis.
So there you go, whole host of opinion. One camp suggesting that it's going to be a bit of a non-event. The other camp suggesting that if the Fed does hike, finally, after 10 years, then it's going to actually lead to a relief rally because in a sense the uncertainty will be over. Now, Dalal Street is going into the cruise